Hey, okay, this is kind of embarrassing to admit on camera, but I almost did it again this morning.
Did what?
The pop-up on my credit card app, it said, update your annual income to help us serve you better. And I had my thumb literally hovering over the field and I stopped myself.
Good.
But only because I remembered what you told me, because honestly, my first instinct was just to fill it in. Like, it feels so routine, you know?
That's exactly what they're counting on, that feeling of, oh, it's just a form. But Lynn, the second you type that number in, the bank's algorithm starts running. Your entire profile gets repriced, and none of that repricing is designed to help you.
Wait, repriced how?
That's the whole conversation, because there are three very specific ways banks weaponize that number, and most people have genuinely never thought of any of them. And there's also this whole question of when are you actually legally required to tell them, because the answer is a lot less often than banks want you to believe.
Okay, I need to know all of this.
Well, that's why we're here. I'm Frank.
And I'm Lynn. Welcome to Talk and Wonder. We make whiteboard animations about family finance, investing, passive income, and getting out of debt. Basically, all the stuff banks and financial institutions would prefer you never fully understood. Our goal is to break down how this system actually works, help your family avoid the traps, and build real wealth together.
And if any of that sounds like exactly what you need right now, you're in the right place. So let's talk about why you should probably stop filling out that form. So let me start with something that honestly kind of irritated me when I first found out. Banks are not required to ask for your income in most situations. Like, there's no law that says your credit card company needs to know your salary, no federal regulation requiring your bank to have a current income figure on file.
Wait, seriously? It always felt like mandatory information.
Right, and that's the whole game. They ask because they want to know. They ask because knowing helps them make more money from you. And there's a massive difference between something being legally required versus something being requested. When it's legally required, you have to provide it. When it's a request, you have choices. Banks deliberately blur that line because, informed customers make decisions that hurt bank profits.
That's kind of unsettling when you say it that loud.
It should be. So, think about the last time you applied for a credit card. There's an income field. You filled it in, right? Didn't think twice.
I mean, everyone does.
Everyone does. But here's what happened the second you hit submit. The bank's algorithm instantly, and I mean instantly, categorized you. Your income became a data point in a profile, and that profile determines, okay, it's not just whether you get approved, it's what interest rate you pay, what credit limit you receive, what offers you see when you log in, and how aggressively they market additional products to you. It's the whole relationship gets shaped by that one number.
Okay, so break that down. Like, what are they actually doing with it?
So, there are three specific mechanisms, and the first one sounds the most reasonable on the surface: credit limits. Banks use your stated income to figure out how much credit to extend. Higher income, higher limit. And yeah, okay, that part makes sense. Someone bringing in $150,000 a year can theoretically handle more debt than someone at $50,000.
Right, that seems fine.
It seems fine until you flip it around, because higher credit limits aren't always in your interest, Lynn. They enable more spending. They create more opportunity for debt to accumulate, and they increase the total interest you might pay over the life of the relationship. Banks actually know, and this is documented, that people with higher limits tend to carry higher balances.
So a higher limit isn't a reward, it's a longer leash?
It's more rope. Yeah. The bank isn't handing you a $30,000 credit limit because they respect your financial success. They're giving you more rope because customers with more rope tend to, hang themselves with interest payments. Their words, not mine. Well, not literally their words, but that's the math.
That's bleak.
The second mechanism is where it gets really interesting. interest rate determination. And this is the one that genuinely surprised me when I first understood it. You'd assume, right, that higher income means lower interest rates, higher earners or lower risk, so they get better terms.
That's what I always assumed.
Most people do. But the reality is more complicated. Banks use income data in combination with a bunch of other factors to determine not just your risk level, but your price sensitivity. And those are two completely different things.
Price sensitivity, meaning whether you'll notice if they charge you more?
Exactly. Someone earning $200,000 a year is statistically less likely to shop around for a better rate. They might not notice a few percentage points difference, or they notice and just don't bother switching. The algorithm knows this. It adjusts accordingly. There are actually studies showing that affluent customers sometimes receive worse terms than they should because banks correctly predict they won't negotiate or switch providers.
Wait, so your high income becomes a signal that you can be charged more?
That's exactly it. And this practice has a name in banking circles. It's called ability to pay pricing. The more you can afford, the more they charge, not because you're a higher risk borrower, firmly, but because they can get away with it.
Okay, I need a second.
I know.
So families who work really hard to build their income, they can actually end up paying more at the bank because of that income?
In some cases, yes. And the frustrating part is you'd never know. You'd just think, oh, I got this rate, seems reasonable. You'd never see the rate the person next to you got with half the income.
That's maddening.
The third mechanism is marketing and upselling, and this one is the most persistent. The moment you reveal your income, you're categorized for targeted offers. And look, I want to be clear, this hits differently depending on where your income falls. High earners get aggressive pitches for premium cards. We're talking $500, $550 annual fee cards. Constant offers for personal loans, investment products, insurance packages. Every single time you log into your account, it's an obstacle course of upsells calibrated specifically to your income bracket.
I feel so seen right now. Like, I swear our credit card app has been trying to sell us stuff every time I open it.
Because it is. And they know that someone earning, say, $180,000 is statistically more likely to say yes to a $550 annual fee than someone earning $60,000. But, and this part is important, lower income customers aren't protected from this either. They just get a different version. Fewer premium offers, but more predatory ones. Balance transfer promotions with hidden fees, personal loans at steep rates, credit limit increases specifically designed to enable overspending.
So basically, everyone gets targeted just differently.
The targeting is precise because the data is precise. And here's the thing that most people never stop to consider. That income figure you entered on your application, it doesn't just sit there doing nothing. It's actively working right now. It's in your file. It's being used for decisions you'll never see. And in many cases, it's being shared with affiliates and partners in ways that your privacy policy technically permits, but that you would absolutely never expect if you actually read through what you agreed to.
Which, let's be honest, none of us read.
None of us read. And look, that's a whole other episode. But the point is, your data has an incredibly long half-life. That number you entered 5 years ago might still be influencing how you're treated today. Whether your limit gets quietly reduced, whether your rate gets bumped during an economic slowdown, banks have very long memories. And
How long are we talking? Like, does it ever actually expire?
that gets into something really important about how the whole strategy works, because there's a specific reason banks send you those update requests so persistently, and it has everything to do with what happens to data when it gets old. So here's the thing about bank data that most people genuinely don't think about. It doesn't expire. Like when you tell a credit card company your income, that information doesn't disappear after your application gets approved. It sits in your file. It gets used for decisions you'll never be notified about. And in a lot of cases, it gets shared with affiliates and partners in ways that your privacy policy technically permits, but that almost no one would expect.
Wait, shared how? Like sold?
Not always sold directly, but look, the technical language in those agreements is deliberately vague. The point is, that income figure you entered could be 3 years ago, could be 5 years ago, might still be shaping how you're treated today, whether your limit gets quietly bumped up, whether you start seeing a specific category of offers, whether during an economic downturn your account gets flagged for review.
So it's just sitting there, working on us.
Actively working. And here's where it gets really interesting, because banks don't treat data equally. Fresh data is valuable. Stale data loses its predictive power. A 3-year-old income figure doesn't trigger the same algorithmic responses as one you updated last month.
Which is why they keep sending those pop-ups.
Firmly, exactly. Every time you provide a fresh update, you reset the clock. You become a newly classified target. The algorithms wake back up, the marketing engine recalibrates, and you start getting treated, for better or worse, based on who you are right now financially, rather than who you were when you first signed up.
Okay, so not updating is actually a strategy.
It can be, and I want to walk through something concrete here because I think the abstract version of this is easy to dismiss. Imagine 2 families, same neighborhood, same credit score range, same spending habits, same payment history, spotless, both of them. The only real difference is what they've done with those income update pop-ups.
Okay, I'm listening.
Family A, every time that pop-up appears, they fill it in. Their income has grown, let's say, from $70,000 to $95,000 over 3 years. Solid growth, they're proud of it, makes sense, they'd update it. Family B has never touched the field since their original application. Same income growth, roughly, just never updated.
And what happens?
Family A, within a few months of that last update, their credit limit gets increased twice without them even requesting it. They start seeing constant offers for premium travel cards with $500 plus annual fees. Personal loan pitches show up in their inbox. The algorithm has looked at that income trajectory, done its math, and decided this household has growing earning power and growing financial complexity. Let's extract more value from them.
And family B?
Standard marketing. Stable credit limit. They essentially fly under the radar. Because the bank's model has less fresh information to work with, it defaults to more conservative treatment. Less targeting, less upselling, honestly, less of everything.
I mean, that second family sounds kind of peaceful.
It does, right? And look, I'm not saying one outcome is objectively better. If family A genuinely wanted that higher limit, fine, the update served them. The point is that most people in family A's position didn't make a conscious choice. They just filled out the form because it appeared. They handed over information without asking what it would be used for.
Which brings me to, okay, I have to tell you about our friend, the one who does contract work.
Oh yeah, tell them.
So she's a contractor, right? Her income is variable. Some months she's pulling in $8,000, other months closer to $15,000, depending on her project load. When she first applied for her credit card, she reported conservatively, used her lower months as the baseline, which honestly makes total sense.
Smart move, actually.
Right? So fast forward 2 years, she gets one of those credit limit increase requests from the bank, and the pop-up says, "Please update your income to process this request." And she thinks, okay, fine, I do earn more now. She enters her current numbers, which are substantially higher than what she originally put down.
And then?
Then, within 3 months, Frank, she starts getting constant calls about personal loan products. Her credit card offers completely shift to high annual fee premium cards. Her mailbox is suddenly full of balance transfer promotions. She told me it felt like she'd accidentally walked into a sales office and couldn't find the exit.
Because she had. The moment she entered that updated number, she got reclassified. The algorithm saw a significant income jump, updated her lifetime value calculation, and immediately redirected the full weight of the marketing engine toward her.
And she had no idea that one form field would do all of that.
Nobody does. That's the whole point. But here's the part of her story that I actually find really useful. After that experience, she never updated her income again. Every time those pop-ups appeared, she just closed them. Didn't fill anything in, didn't call anyone, just closed it.
And what happened?
Measuredly, within about 6 months, her account returned to what she called normal. The calls slowed down, the premium card pitches tapered off, the aggressive marketing essentially went quiet because the algorithm had stopped receiving fresh signals from her, and the income data she'd entered was getting stale, less predictive, less actionable, so she drifted back toward default treatment.
6 months.
6 months. And she didn't lose anything. Her account stayed open, her credit score didn't move. The bank just didn't have the fresh ammunition they wanted. And without it, they couldn't optimize against her as precisely.
So the algorithm is kind of like, okay, it's like a smoke detector, right? It needs fresh air to keep going off. You stop giving it something to react to, it goes quiet.
That's actually a really good way to put it, yeah. The system is optimized for fresh information. Old data decays, and that decay is actually a form of protection for you if you understand how to use it.
Which means every single time you hit update on that pop-up, you're basically pulling the pin on a grenade aimed at your own wallet.
Well, I wouldn't have put it quite that dramatically, but yeah, that's the math. And the really unsettling part is that banks know this. That's why the pop-ups come back every 3 months. That's why the phone calls happen. That's why the wording says, "Help us serve you better," instead of "Help us reclassify you for more profitable treatment." They need you to voluntarily reset the clock because
Because they can't force you to.
they can't force you to. And that brings up something that I think a lot of people are genuinely confused about, because there's a real legal distinction here that banks work very hard to blur. When do you actually have to disclose your income? And when are you completely within your rights to close that pop-up and walk away? So here's the question I know everyone's been sitting with. When do you actually have to tell a bank your income? Like legally, genuinely have to.
Because it does feel like there must be some situations where you can't just close the pop-up.
There are, and I want to be really clear about this because the last thing I want is for someone to hear this conversation and think, oh, I'll just lie on my mortgage application. No, that's fraud, that's illegal, that's genuinely wrong, and we're not talking about that at all.
Hard no on that one.
Hard no. So, the situations where disclosure is real and required. Mortgage applications. This one is federally mandated. Banks must confirm your ability to repay under qualified mortgage rules. You'll provide pay stubs, tax returns, employment verification, the whole picture. There's no getting around it. And honestly, you wouldn't want to.
Right, because, buying a house you actually can't afford is how you end up losing the house.
And it's what caused the 2008 financial crisis. Lenders were approving mortgages with no real income verification. People were getting into homes they couldn't sustain, and then, well, we all know how that ended. So that requirement exists for a reason. It protects you, too.
Okay, so mortgages required. What else?
Auto loans typically require income disclosure, though the verification standards vary. Some lenders do full documentation, others accept stated income. It depends on the lender and the loan amount. But generally, yeah, when you're borrowing a significant amount, they want to see something real.
That makes sense. So what about credit cards?
Okay, this is where it gets interesting. Credit card applications ask for your income. You've seen the field. Everyone has. But here's what most people genuinely don't know. Credit card companies do not verify the income you report. They can't access your tax returns without your permission. They can't see your pay stubs. They're relying entirely on what you tell them.
Wait, so they're just taking your word for it?
Entirely. And look, I'm not saying you should lie. Providing false information on a credit application is still fraud. But there's a significant difference between lying and being thoughtful about what you report. If you have variable income, you don't have to report your best month. If your income has multiple components, you don't have to include every single one. Report accurately, but don't volunteer more than necessary.
Huh. I never thought about it that way. Like, there's a version of honest that's also strategic.
Exactly. And then there are those periodic update requests, the pop-ups, the emails, the phone calls, asking you to refresh your income information on existing accounts. Those are entirely optional, zero legal obligation, zero penalty for ignoring them. The bank wants the data, they don't need it.
So why do they make it look so official?
dryly because official-looking things get filled out. They're designed to feel mandatory while being completely voluntary. The form, the friendly wording, the implied urgency, it's all constructed to maximize how many customers comply without questioning it.
That's so manipulative.
It is. And here's the thing that I think about a lot with this. Banks have spent decades training customers to feel obligated to answer when asked. The request carries implicit authority. The form creates implied requirements. Most people comply not because they've thought it through, but because non-compliance feels awkward or risky, or like you're doing something wrong.
I literally felt that this morning with the pop-up.
I know, and breaking that conditioning, the first time you close one of those windows without filling it in, you might feel a little anxious, like, did I just do something wrong? Will there be consequences?
Will there?
Calmly, there won't. The bank will ask again, you'll close that one too, your accounts will function exactly as they always have. And quietly, over time, you start to realize how much of banking is theater, designed to create compliance from customers who don't know they have choices.
So we always had choices. We just didn't know.
You always had choices. The bank just preferred you didn't know that. And, speaking faster, once you see it, you can't unsee it, which is actually a really good place to be, because now we can talk exactly about what to do from here. So let's make this practical, because I think the mindset shift is important, but what people actually need is, okay, what do I do next Tuesday when that pop-up appears again? So let me just go through this clearly.
Yes, give us the playbook.
First situation, new credit card applications. You're applying for something new, there's an income field, it feels required. Here's the thing, for a new application, providing income is essentially necessary for approval. So yes, fill it in. But be thoughtful about what you report. If your income is variable, you don't have to use your highest month as the baseline. If you have multiple income streams, you don't have to volunteer every single one. Report honestly, but don't over-report. There's no rule that says you have to make yourself look as financially attractive as possible to a bank.
That's actually kind of liberating to hear.
Second situation. Those periodic income update requests on accounts you already have, pop-ups, emails, the little banner that appears when you log in, close them. That's it. No explanation needed, no reply required. Just close them. There is no penalty. There is no consequence. The bank wants that information. They don't need it. And the difference between wanting and needing is exactly the space where your choice lives.
Ugh, I really wish someone had told me this 10 years ago.
Third, credit limit increase requests. Calmly, this one requires a split-second decision first. Do you actually want a higher limit? If the answer is genuinely yes, maybe you're planning a large purchase, maybe you want to improve your utilization ratio, then providing updated income to support the request might serve you. But if you're happy with your current limit or you're not sure, decline the request rather than providing income data to enable an increase you didn't ask for and don't need.
And declining doesn't hurt your credit score?
Doesn't touch it. Fourth, loan applications where income verification is actually required. Mortgage, significant auto loan, personal loan above a certain threshold. Here, the rule is simple. Provide what's required and nothing more. If they ask for tax returns, give tax returns. If they ask for pay stubs, give pay stubs. But if they start requesting documentation beyond what's legally required, ask why before you comply. You're allowed to ask that question. Banks are not always accustomed to customers who ask it, but you're completely within your rights.
I feel like that question alone, just asking, why do you need this, would make a lot of people uncomfortable.
It makes the bank uncomfortable, which is kind of the point. Fifth situation. Phone calls. Someone from your bank calls asking to update your income information. Phone calls are specifically designed to create urgency and immediacy. They put you on the spot. The silence feels awkward. But here's what you can say, word for word. I'm not interested in providing that information right now. That's it. The call ends, your account stays open, nothing happens.
That's so much simpler than I thought it would be.
It always is. And look, I want to zoom out for a second here, because I think there's something bigger underneath all of this. every institution that asks for your data is collecting it for their benefit, not yours. They may frame it as serving you better, improving your experience, ensuring accuracy, but those framings obscure the actual purpose, which is enabling more precise extraction of value from your relationship with them.
Data minimization, that's what you called it before.
Data minimization, and it applies way beyond banking. Provide what's required, decline what's optional. Understand that every piece of information you share will be used, analyzed, and monetized in ways you cannot see and probably wouldn't approve of if someone actually walked you through it.
That's a lot to sit with.
It is. And look, I want to zoom out for a second here because I think there's something bigger underneath all of this. Every institution that asks for your data is collecting it for their benefit, not yours. They may frame it as serving you better, improving your experience, ensuring accuracy, but those framings obscure the actual purpose, which is enabling more precise extraction of value from your relationship with them.
Data minimization, that's what you called it before.
Data minimization, and it applies way beyond banking. Provide what's required, decline what's optional. Understand that every piece of information you share will be used, analyzed, and monetized in ways you cannot see and probably wouldn't approve of if someone actually walked you through it.
That's a lot to sit with.
It is. And look, I want to leave people with this sense of banks are evil, the whole system is out to get you. That's not really the point. Banks provide genuinely valuable services. Credit cards, loans, deposit accounts. These things enable economic participation in ways that benefit everyone. But banks are also profit-maximizing institutions that treat customer data as a resource to be mined. And understanding that dynamic doesn't require cynicism. It just requires clear-eyed awareness of how the relationship actually functions.
They're not your friend, but they're not your enemy either. They're just a business, doing business.
Exactly. And like any business relationship, you negotiate. You decide what information to share based on what serves your interests, not theirs. You stop operating on autopilot and start making conscious choices about the terms of the relationship.
Okay, so last question, and I think this is the one people are really going to want answered. If I've already updated my income, like multiple times, is it too late? Is the damage done?
No, and this is the part I actually love about this, because here's what the data shows. Banks are optimized for fresh information. Stale data loses its predictive power over time. An income figure you entered 2 years ago has already started to decay. It triggers less algorithmic activity than a recent update would. So the moment you stop providing fresh data, the clock starts running in your favor. Your profile gradually drifts back to default treatment. Not overnight, but within months, the targeting quiets, the aggressive marketing tapers, the upsells become less precisely calibrated.
So you can essentially opt out retroactively, just by stopping.
Just by stopping. And from this point forward, let your behavior speak. Your payment history, your utilization rate, how long you've kept accounts open. That's the data that actually tells a real story about who you are financially. And unlike a number you type into a form, they can't get that just by asking nicely. They have to watch you over time. And if you're doing the right things, that record speaks louder than any income figure ever could.
I really feel like we should have done this episode years ago.
Honestly, yeah, but better now than never. And if this changed how you think about that pop-up the next time it appears, that's the whole win. Just close it. Let your history do the talking.
And if this episode helped you think differently about your family's relationship with money and banks, we'd really love to know. Drop a comment, tell us what surprised you most. And if someone you know is still reflexively filling out every form a bank puts in front of them,
share this with them, because that little habit, that one small moment of automatic compliance might be costing them more than they realize, and now they'll know they have a choice.
I'm Lynn.
And I'm Frank. Thanks for spending this time with us on Talk and Wonder. We'll see you in the next one.